Welcome everyone to today's webinar on navigating macro regime shifts and inflation surprises. I'm Marielle Sexton, Director of U.S. Institutional Sales here at Unigestion, and I will be the moderator for today's discussion. Before we get started, I want to just take care of a few housekeeping items. Our session today is being recorded and will be available for us to share later today. We will try to stick to the 30-minute time frame, but we will leave time at the end for Q&A. So please feel free to type your questions into the text box at the side of your screen. If we do not get to your question today, we will follow up with you afterwards. Now, let's get started. I'm joined today by two of my colleagues from our cross-asset solutions team. Guilhem Savry, Head of Macro and Dynamic Allocation.
Hello everyone, glad to be here.
And Salman Baig, Portfolio Manager.
Hi, Marielle. Hi, everyone.
Unigestion's cross-asset solutions team manages about $2 billion of our total $22 billion in assets in multi-asset alternatives, including our global macro strategy, which will be the focus of today's discussion. I'm going to just give a quick overview of our global macro program, which combines both systematic and discretionary investment approaches. The portfolio pictured here in the pie chart is comprised of three underlying strategies, which take both directional and relative value positions across more than 63 liquid markets. Many of these elements featured here will factor into today's discussion. So, inflation is on everyone's minds these days, as the global economy transitions to a hopefully post-COVID world thanks to the vaccine rollout. Coming into 2021, our outlook here at Unigestion was in favor of continued growth, with rising but normalization of inflation, a classic Goldilocks scenario, in which widespread vaccine distribution would release pent-up demand from investors keen to deploy capital coming out of the coronavirus pandemic. However, over the first quarter, we saw a noticeable shift pointing to the possibility of a large inflation surprise from some of our portfolio's indicators. I'll pose the first question to Salman. Salman, what has been happening in terms of macroeconomic regime and in global markets over the last several months, and why do you think inflation could overshoot expectations?
Yeah, so just to be clear, Marielle, I think we think inflation should be higher than market expectations or consensus for one primary reason. We're in uncharted territory. We've got an extraordinary policy mix, extreme pent-up demand, and supply risk that, the three of which have never really been seen. The next few slides are going to highlight just how these elements are all pointing in the same direction. So if we go to the first chart here, the first point to make is, as we all know, the policy mix, monetary and fiscal, is unprecedented. So if we look on the left chart shows essentially government spending going back a few years, and you can see that the amount of fiscal impulse today is massive, right? More than 2008, and at this point represents about 10% of global GDP. On the right chart, we see on the monetary side that central bankers have moved from a mantra of fighting inflation to actually creating inflation after years of undershooting targets. The new average inflation target framework from the Fed shows that central banks are ready to accept more inflation for longer. What this is translated to, if we look at the next slide, is an extreme savings rate for both for households and for corporates. So this slide here on the left, you've got household savings rates in the US and Europe, and on the right, we're looking at cash on corporate balance sheets for US firms. And the basic picture here is there is obviously a lot of pent-up demand and the likes of which, again, we've never seen before. We believe that once uncertainty declines with an improvement in the pandemic, that this money on the sideline will be spent and create essentially an extreme demand surge. as a reflection of this, if we look at the next slide here, we can already see that the ISM new orders have picked up quite dramatically. So the chart on the left shows you the data for both the manufacturing and services sector, and you'll see that both of those are at record high levels, already putting pressure on inventories. That's on the demand side. On the supply side, our conviction about upcoming higher inflation is reinforced by another, really extraordinary element, the risk of disruption. So as opposed to previous demand surges, disrupted supply chains and deteriorated capacity after more than a year of restrictions and lockdowns mean that we think supply will have difficulty meeting the demand. And it's not just our view. It's also the main finding from the latest business inflation expectation survey by the Atlanta Fed. So you can see on the right, that right table, that the survey is highlighting the risk of supply disruption, with over 50% of respondents saying they've been impacted by supplier delays.
Okay, let me just stop you here for 1 second. So Salman, what I'm hearing is policy mix has been a huge support, and this will continue for some time. There's a lot of pent-up demand waiting for uncertainty to come down, and you're seeing some of that come online while supply issues are starting to hit.
Yeah, that's right.
Okay, so then how do you put all of that together? What does that mean for inflation?
Yeah, so the sort of uncharted territory that I was talking about, both for macro data and fundamentals that we find ourselves in, it's leading us, I'd say, to reevaluate the typical linkages and consequences of macro forces. Historically, as shown on this chart, forward inflation depends on, no surprise, supply and demand. And as you can see that this chart shows is that relationship, generally speaking, shows that stronger global consumption leads to higher future realized inflation. No surprise. If we put our forecast for consumption growth into this, call it historical perspective, we get our estimate for inflation for this year being about 3.5%. That's already quite a bit up from the consensus estimates, which is, call it a little bit under 3% at this point. The key point I want to highlight is that the scarcity point, the supply disruption point I was raising earlier, that has the potential to really dramatically change this relationship, where you'll see that sensitivity to inflation, the sensitivity of inflation to demand picking up a lot more and leading potentially to a large surprise for investors. I should also mention that we're already seeing signs that the risk of an inflation surprise is here. We track inflation systematically through two primary indicators: our proprietary inflation nowcaster and our newscaster. Both have shifted meaningfully in the last, I'd say, 6 to 9 months, and agree that there's a very high risk of an inflation surprise at this point.
Okay, so that's the story with macro conditions. But Guilhem, as you know, financial markets are seen as efficient. So then, aren't these elements already being priced in?
Yes, Marielle, as you know, markets reacted a lot to higher inflation risk during the first quarter. That has driven a large rotation across and within assets. So overall, cyclical assets, meaning assets which benefit the most from a stronger global trade, higher inflation, higher activity, outperform defensive and nominal ones. As you can see on the left chart, commodities outperform sovereign bonds, which deliver the worst quarterly performance since a while. Within S&P sector, as you can see, energy, financial outperform tech or healthcare, and across style or factors, value outperform momentum. So back to the question, Marielle, I would say yes, market has repriced a potential shift in the inflation regime. However, we see these adjustments as partial, and we believe the rotation observed in the first quarter will continue and even amplify. Why? Because the adjustment we have observed for the real rates is too low. And you can see on the left chart, and despite an increase of 30 basis points in the first months of the year, the current level is roughly minus 70 basis points for the real rates in US. It represents, as you can see on the left, less than 10% of the history since 1963. So it's very low. It's low as well when you compare it to fundamentals. On the right, we compare the US real growth with the US real rates. As you can see, since 1963, the relationship has been strong, very correlated. But if you put the forecast for from the Fed, New York Fed, for the first quarter of the year, roughly 6%, as you can see on the right chart, the gap widens and looks very large. That's why we believe, we expect a higher real rates in coming months, and then a continuation of the rotation we have observed during the first months of the year.
Okay, so let's say I agree with you that real rates are too low and there's room for them to move higher, which would support pro-cyclical moves. But what does that mean concretely for asset performance? Where are the best opportunities to generate returns in this kind of inflationary scenario?
Good question, Maria. I would say in case of inflation surprise environment, it's key to allocate rightly your risk and capital toward assets that perform well in this specific environment. That's the reason why we like real assets, such as inflation break-even, industrial metals, energy commodities. And we have a preference for these specific assets for three main reasons. Firstly, historically, our analysis shows that specific assets have the best one to have or to increase in the portfolio in case of high inflation risk or very high inflation risk environment. Here, as you can see on slide 17 on the chart, we look at the excess Sharpe ratio, meaning how well do these assets perform versus their history. As you can see, these assets or real assets perform very well in case of high inflation risk or very high inflation risk context. So it's important to look at the historical performance, but when we allocate dynamically our risk, we look also at the positioning. And on next slide, as you can see, real assets currently are underowned by active manager. Here we look at the exposure from macro hedge fund, from CTA, and as you can see, their exposure through the beta analysis we have developed internally, their exposure, their beta to real assets is currently low and lower than the history. So for us, in our view, there is room for an increase of their exposure to real asset, and then a big support for future return of inflation break-even and cyclical commodities. Last element in our analysis, we have analyze the historical return for real assets, the positioning. It's also key to assess what is priced in currently. And as you can see, as you know, there is a debate between Summers and Guilhem about is it durable or transitory. Currently, the market seems in line more with Guilhem about transitory inflation surprise. And we look and we monitor two elements to confirm this pricing. On the left, as you can see, we look at the forward curve for the futures commodities, the most cyclical one, copper and oil. And as you can see, these curves are currently in contango, meaning the market do not believe in the durability of the extra boost for cyclical commodities. Another element which is important to confirm the market is pricing a temporary shock for inflation surprise. On the right, we look at the US break-even forward curve, which is inversed currently, that confirm a transitory pricing for inflation surprise. So as a conclusion, if as us, you believe the inflation surprise, the inflation shock could be larger or more sustainable than the current pricing shows, it would make sense to add or to increase your allocation to real assets.
Okay, thanks for that, Guilhem. You and Salman have both talked a bit about why you're expecting higher inflation and how that's different than what markets are pricing. But I think it might be helpful for our audience if you could provide a few concrete examples of how exactly the strategy has adapted to these changes over the past few months.
Yeah, maybe I'll start off, and Guilhem can also come in. So, I'd say over the recent months, there's been adjustment to our position that's been driven by one key narrative. We believe that the reflation will drive rotation and hence dispersion across and within assets. So we've played this rotation both at the asset class level and then within specific asset classes, in particular currencies and equities. So the next few slides will step us through some of the changes to our strategy or portfolio. So the first example here is just to highlight how our preference for those assets that have historically performed well during inflationary periods, namely real assets, right? So inflation break-evens, commodities that Guilhem was talking about before, how we've moved from essentially a bearish or short position in the, basically in the middle of last year or first, second quarter of last year to a more neutral position towards the end of last year and transition further into a more bullish long position, right? So that's the basic story on the left. On the right, we're looking at the same allocation, but this time broken down into the underlying investment processes of the strategy. So as Mariel was mentioning before, the strategy is a combination of systematic and discretionary. And you can see that by and large, this was a fairly consensus view across both of those investment engines. And what that meant is it led to a fairly high conviction view and has been one of the key returns contributors so far this year. The second point I'd want to highlight is sort of on the flip side, we also want to move out of assets that we think will perform poorly in an inflationary environment, in particular sovereign bonds, right, or duration risk. So again, the chart on the left, we're looking at the overall allocation through time, and you can see it's a bit of the inverse from the real assets example, right, where in the first and second quarter last year, we were long government bonds for obvious reasons, and then as the year progressed, reduced to a more neutral exposure, and then this year, especially in Q1 of this year, have moved meaningfully short. On the right, again, same allocation, but this time broken down by the different books of the strategy. And here you can see that, again, there is some overlap between the systematic and discretionary. They do sort of somewhat move together, but there is some dispersion if you sort of look closely. And what this means is that the sort of short duration exposure has been a particularly important positive contributor for our systematic books so far this year. So that's sort of where things are, as I said, sort of the key at the asset class level for a couple of the key assets. Maybe, Guilhem, you can step through some of the more granular market bets we've got on.
Yes, of course, Salman, thanks. As we mentioned previously, dispersion has been large across and within assets because of higher inflation risk. Our preference for cyclical asset pushes us to be more selective in our bets, and then we have increased in our portfolio during the first quarter the proportion of relative value trades. We have used two specific markets to implement these relative value trade during the first month of the year. Firstly, the currency markets, which usually provides a lot of opportunities to play differences or divergences across countries. As you can see on the left, the proportion of FX bets has increased sharply during the first months of the year. For instance, we added in our portfolio long Norwegian krona versus Swedish krona, or long Canadian dollar versus Swissy for playing cyclical economy, cyclical currency versus more defensive one. We have used also US equity market to implement relative value trade. On the right, you have the chart of our allocation in Russell and Nasdaq. I like a lot the chart because it reflects perfectly, firstly, the granularity of our investment process, investment universe, and secondly, our ability to move quickly and to change sharply our positioning. On the right chart, as you can see, at the beginning of the year, we were long both indices, Russell and Nasdaq, but with the rising bond yield environment, we shift significantly our view for the Nasdaq. We stayed long Russell to benefit from its higher historical sensitivity to activity, to inflation, to global trade. But because of higher implied duration embedded in Nasdaq, we turn from long to short, as you can see on the right chart. Now, if we move on the current positioning of the fund, as we mentioned with Marielle, with Salman, we believe in the continuation of the reflation theme. We believe in the sequence, reflation, rotation, dispersion across and within assets. So consequently, when you look at our current positioning on the left, no surprise here, we are short duration, we are long growth and real assets, so long break-even, long commodities, long investment grade, long developed equities also, which is important to note as well on the right is which shows the historical capital allocation by asset class, historical allocation to bonds, to break-even, to equities. As you can see, currently, our net exposure is low and lower than in the past. It reflects our preference for relative value trade over directional reuse. So, in a nutshell, for alpha versus beta.
Okay, great. Thanks, Guilhem. Maybe I'll just quickly touch on recent performance as well before we wrap up and start taking a few questions from the audience. So we've got two charts here, and if we look at the right-hand chart, we see the strategy delivered about 3.9% during the first quarter, with all three books up and in line with our expected contributions. But importantly, if you look on the left, we see returns are coming from multiple sources this year, which is very different to last year. In 2020, performance was driven mainly by equities and credit. However, this year, we see more diverse return contributions. In particular, if you look at this chart, you'll see FX, commodities, and a short position in duration really outperforming. This is reflective of our views that out-of-control inflation is a risk that shouldn't be ignored, and exposure to the right asset classes and markets is important in a high inflationary environment. I think ultimately, though, it's important to remember we don't have a crystal ball, and we don't know what the future holds this year or beyond. We could easily be wrong about how the year will shake out, and this is why it's critical to have a portfolio that is diverse across strategies, instruments, and time horizons, and one that can adapt to changes in markets and shifts in macro regimes. Being flexible matters more than being right, as ultimately our goal for the global macro strategy is to deliver positive risk-adjusted returns for our investors. An announcement that I just want to make before we start addressing some questions. We're very pleased that June 1st, we're going to launch the strategy in a UCITS format. So we will be launching a UCITS vehicle on June 1st for the global macro strategy, and we will offer a founder share class at discounted fees. And I think with that, I will turn it to the audience for some questions. Our first question asks, how are you so sure of this inflationary outcome, and what might make you change your views?
Marielle, I will start with this one, if you want. As you know, we call our investment process macro risk based because we believe, we think macro matters for asset return in the medium term. We believe also the risk is multidimensional. So we monitor activity, inflation, market stress, valuation through different signals, indicators, that can be either systematic or discretionary based to identify risk and opportunities. So if one or several signals change, we are able to modify quickly our allocation. The example done by Salman for duration, for our shift over the last 6 months on duration, illustrates perfectly how dynamic we can be. So currently, back to our narrative, our belief about continuation of rotation and the reflection theme, we monitor a lot of elements. For instance, if valuation of real assets would increase, we could modify our positioning toward these kind of assets. Another example, if the newscaster highlight the risk of deceleration in the macro momentum, we could also challenge the risk or the probability of inflation surprise. So as you can see, we have different indicators to monitor, but currently with the rotation, the reflection theme, the key element to track, in our view, is the risk premium embedded in the bond yield, meaning inflation premium and gross premium. If you observe a sharp decline in one or both of these premium, we could modify very quickly and very dynamically the current views about reflection and continuation of rotation. But for the time being, for now, there are no sign of change in these different elements, but that's something we monitor very closely to adapt our portfolio to the potential change in the global context and macro environment.
Great, thanks, Guilhem. Salman, maybe you can take this next one. Can you tell us more about your nowcasters and newscasters? How do they work and what do you use them for?
Yeah, sure, happy to take this one. So, as Guilhem mentioned, we monitor different market drivers, and in our view, macro is primary among them. So, in order to consistently assess the evolution of growth and inflation, we've developed high frequency, so meaning daily systematic indicators that give us a real-time read on these forces. The nowcasters are one set, right? So that's one approach, and are based on quote unquote classic macro data like the ISM, retail sales. On the inflation side, things like export prices, PPI, and so on. The newscasters are another set of indicators, and they take a somewhat different approach, and essentially are driven by media reporting on growth and inflation. They rely on machine learning, big data, to essentially take news articles and transform them into macro indicators. Both of these approaches, though, are after the same concept. How far is the global economy from its underlying potential? And that then allows us to understand the state and evolution of macro conditions and respond accordingly. I should also point out that the nowcasters and newscasters, they ultimately are transformed into a set of exposures, long or short, in the strategy. They're actually the bulk of the allocation in what we call systematic macro allocation, the systematic macro allocation book that Mariel showed earlier. So they're not just monitoring, and they're not just an academic exercise. They're really directly impacting our positioning. And we expect and have seen the two approaches be fairly complementary with low correlation signals and returns, which is why we combine them together.
Thanks, Salman. I think that was really helpful for the audience to get a better sense of some of the processes underpinning the strategy. Unfortunately, we're going to have to leave it there today because we're coming up on time. It's exactly 2:30. I'm very proud of us for staying to our 30 minutes. If we didn't get to your questions today, we can follow up with you directly. Please feel free to reach out to us if you have interest in learning more about the Global Macro Program or in discussing today's topic further. I also want to reiterate our upcoming UCITS launch on June 1st, which we're very excited about. Thank you, everyone who attended the webinar today, for your interest, your engagement, and your questions. And thank you, Guilhem and Salman, for your time today as well. Have a great rest of the day, everyone.
Bye-bye.
Bye.